Welcome to the Capital News. I am your host, Alex Kreitis. Today is May 1st. It's May Day. It's also the Fed Day. We had some noise from the Federal Reserve and what happened in the markets today. Well, the S&P was down 22 points. The Dow closed down 163. The NASDAQ closed down 46 points. And the Russell 2000, the small cap index, closed down about 15 points for the day, which was just shy of being closed down 1 full percentage point. Oil is at $63.40, down on some inventory news. There was an increase in inventories. Of course, that was unexpected. Everything is a surprise to everybody. So there was a drop in the oil price, but not too much. Again, we still got a lot of noise out there regarding geopolitical events, Venezuela in particular. Gold, meanwhile, is down, as is silver. Gold is at $1,274 an ounce, so it took a nice little licking today. Silver had hit 4-month lows and now sits at $14.65. So for those of you who may value precious metals and want that as part of your portfolio, it's definitely a part of mine. Well, buy low, sell high. So this might be a buying opportunity for those of you who are paying attention to some of the precious metals markets. And again, here we recommend if you're going to own it, own the physical, not the paper. Or if you're going to go in and do something as far as trading is concerned, own the mining stocks. Stay away from the paper trading. I just don't like it. I mean, if you like it, do what you want to do. But my advice, what I do, I stay away from it. The 10-year Treasury whipsawed around today. We're going to talk about that as far as what was said with the Federal Reserve, which was the case with stocks and a whole bunch of other financial assets. But it was relatively unchanged, but it was slightly up. This is the 10-year U.S. Treasury. Now sits at 2.511%. Meanwhile, the VIX, the volatility index, was up nearly 13 percentage points for the day, settling at $14.80. So what was going on? Well, obviously, the Federal Reserve came out, gave their decision. We knew what it was going to be. This was no shocker to us, and nor was it a shock really to the markets either. Nobody was expecting a rate cut or a rate increase. We were expecting the Fed to come out and reiterate what they've been saying since the end of last year, which is we are in wait-and-see mode. We are data dependent. Everything's okay. But some things are slowing down here. Some things are picking up there. It was the status quo, mumbo-jumbo. Not too much to write home about. Immediately after the decision, you saw some weakening in the dollar. However, the dollar regained its footing. But right now, it's trading mixed against a basket of currencies. So depending on what you're looking at, maybe the dollar's up, maybe the dollar's down. But sort of right after the announcement, the dollar did take a little bit of a dive, but it was able to recover. The stocks, on the other hand, the stock market, everything went up following the initial reading. Then it started to go down, then it started to go back up. And then obviously, as the Federal Reserve Chairman Jerome Powell was speaking, the stock market was going up and down, mainly down. Especially towards the end of the speech, mainly towards the end of the day, we really start to saw a bigger decline across the board. S&P, Dow, NASDAQ, Russell 2000. Even though Apple came out, and we had that discussion, beating the socks off of the estimates. All right? So the NASDAQ was trying to hold on to some gains off of that good news, quote-unquote good news coming out of Apple, but it just wasn't able to do it. So what was some of the rationale, perhaps, as to why this was, beyond just living in the financial world of Oz? Well, Jay Powell came out and basically said, well, yeah, you know what, the 3.2% GDP number, I mean, that's a solid number. Some things look good. The global growth story is kind of, it's weak. Things are going down, but there's really no reason for us to cut interest rates. And there's no reason at this point to increase interest rates either. So again, we're going to be in wait-and-see mode. We're going to be patient. We're going to be data-dependent. And we're just going to see what happens. But there were a couple interesting things that I thought that Jay Powell said during his Q&A session this afternoon. One of them really had to do with the inflation story, because there's a lot of people out there in the markets, again, full-heartedly in my opinion, who are now looking for any excuse whatsoever for the Federal Reserve to cut interest rates. And this is even in agreement with what the president tweeted out the other day, which we read here yesterday, regarding inflation being wonderfully low. That's how the president put it. But there's a lot of people in the markets, too, that are saying, look, inflation's low, so, it gives the Federal Reserve some wiggle room if they want to cut interest rates We don't have to worry about the economy overheating or anything like that because we're in the midst of the greatest economy ever. We can absorb anything. So if they lower the interest rates, it's now about, it's not panic. It's not we're seeing a recession or that we're in a recession. It's we're trying to target inflation. We're trying to get inflation up. So if we lower interest rates, that might be a stimulative effect to the overall market and the stock market, and the effect will be, at least this is the argument, this is the theory, that inflation will pick up. So then it could hit its 2% mark, or maybe a little bit above 2%. Remember, the Federal Reserve's out there saying, well, you know, we'll take some symmetry here. What does that mean? Well, since we've been below 2% for a while, maybe we've been at 1.8, 1.7, 1.9, whatever it is, for such a while, well, we can tolerate higher inflation being at 2.1, 2.3, 2.5, whatever they're willing to deal with. I mean, they make it up as they go. We know this. They'll just change the narrative. They'll just move one variable over here. They'll say, well, we're really putting a lot of focus on this for whatever reason. You know the game, guys. This is what they do. It's pitting everybody against each other just to keep everybody on the sidelines. Yet, they do this in the name of transparency. Solve that riddle. So, in regards to inflation, Jay Powell said something interesting about inflation in his view and in the view of the Federal Reserve, that it is transitory, that it's temporary, meaning that inflation is likely to pick up in the near future. Well, if inflation also happens to pick up in the near future, then that pretty much rules out any additional rate cuts unless there is something bad that happens. Whether we report a negative GDP number, or maybe there's some sort of major slowdown in manufacturing, or maybe there's massive layoffs and then the unemployment number starts to tick up. So the only way now that it seems we're going to go, it going to continue to be wait and see. But if inflation does in fact increase, well, maybe we even get a rate cut. A rate hike. I would be very surprised if there was a rate hike to, quote-unquote, fend off inflation. But who knows? I mean, anybody's guess is as good as the next person in this world. It really is. This is a big game that's being played. We have the president out there tweeting. You never have presidents out there talking about this, at least not publicly. What happens behind the scenes, I guess we don't know. But this president is out there tweeting that the Federal Reserve should cut interest rates, not by 50 basis points, which is what he and his economic team has been saying over the recent weeks. He wants a full percentage point decline in the federal funds rate. And he also wants quantitative easing. Now, maybe you can say, okay, if you really support Donald Trump and you think that this is a good policy, well, maybe you can say, all right, well, maybe we can cut the interest rates. That's not really an emergency measure. Maybe he's just trying to hedge his bets and make sure that everything stays afloat. I don't like that argument at all, but if you want to say it, I guess you can maybe make an argument for it. But the calls for another round of quantitative easing, well, he's just off his rocker there because that is an emergency measure. That is a hugely fraudulent and faulty and flawed, if you like the alliteration there, economic policy. It just simply is. So I can't stand that. I can't tolerate that one. Even if we were in the midst of another crisis, I would not be saying, let's go on with quantitative easing. Absolutely not. That is what has been destroying this country for the past 10 years. This is what has been causing the massive amounts of income inequality. It is. Just do the math. Do the research. Listen to this podcast and others like it. Understand what inflation truly is. Understand how it makes its way through the system. Understand who the Federal Reserve is, who they truly work for. Okay? It ain't you and me. It's the banking system, it's major corporations, and it's the federal government. We all pay the price. They get all the benefits. Not about class warfare here at all. But when it's fraud, when it's counterfeit, when it's phony, when it's deceptive, I got a big problem with it, and I voice my opinion strongly here at the Capitol News. And you should too, whenever you're having conversations with friends and family. Educate them. Tell them what you know. Tell them what you hear here. And if you can't explain it well, send them here. Send them to the Capitol News. We'd love to have this audience grow, and it is. Slowly but surely, this podcast is growing, and I appreciate everyone who tunes in. But here we have it. The Federal Reserve now out there saying, well, inflation's transitory. It's temporary. We're anticipating inflation, and it's set to increase at some point, which, in all honesty, I mean, we know that the inflation numbers are all phony. They're all fake. They just don't work. They don't make sense with reality. They want to tell you, oh, yeah, your costs are only going up 1.8%. Bull. Not even close. You wish it was 1.8%. But that's what they tell you. They keep hitting us over the head with a stick, and we keep saying, oh, okay, yeah, just a little harder next time, or a little, just hold off 1 second. It's not how it works. It's not how it works. These are big games being played, and it's the everyday American who's getting squeezed in the process. And I don't like it at all. So this pits the Federal Reserve now against Donald Trump and his economics team, because the Fed is now in a position, if inflation does in fact pick up, and they admit that it picks up, that lowering the interest rate is pretty much off the table. So the stock market doesn't like that, right? The frat boys, the partiers on Wall Street, they want this party to continue. They don't want the punch bowl, the keg, being taken away. So they want lower interest rates. Well, if inflation picks up, well, they're not going to get their wish, are they? So that might be one of the reasons why the stock market sold off to the extent that it did today. Again, one day does not make a trend, so we have to keep focusing on this day after day after day and see what takes place as we move along. Another interesting thing that Jay Powell said during his Q&A session was regarding financial assets, i.e. stocks, bonds, whatever, but particularly stocks. This is the Washington speak for what he's really talking about is stocks here, because that's what they're primarily concerned about. They're not going to tell you this, but you know it is. So financial assets are not extremely overvalued. Financial assets are not extremely overvalued. Why would he throw the word extremely into that sentence? Is he saying there's still room for the stock market to continue to go up? Is he saying we're not in bubble territory yet, but we could be? But we're fine tolerating financial asset prices increasing to the point where they are overvalued or extremely overvalued? I mean, folks, this is exactly what took place 10 years ago leading up to the 08-09 crisis. Wake up! What are you not paying attention to? How do we let these people get away with this? It's unbelievable. The Federal Reserve, 10 years ago, and a little more than that, everything was fine. Nothing was overvalued. Chairman of the Federal Reserve at the time, Ben Bernanke, he was asked point blank, is there a problem in the housing market? Nope, not at all. Housing is fine. It doesn't go down. Prices don't go down. Everything's fine. Then boom, 08-09 crisis occurs. Why? Triggered by the financial crisis, triggered by the subprime losses. These people are never going to come out and admit the truth, or they don't know what they're doing. It could be a combination of both. But here we have now the chairman of the Federal Reserve, Jay Powell, coming out and saying financial assets at this time are not extremely overvalued. So I guess they're overvalued. They're just not extremely overvalued, which I guess doesn't warrant them regulating the markets, which they are a regulator. I don't know if any of you know this out there, but the Federal Reserve actually is a banking regulator as well. They have a lot of power when it comes to regulation. Do they use it? No, they don't use it because that's who they work for. They work for the banks. You think they're going to regulate them? You think they're going to handcuff them? You think they're going to strangle them? No, of course not. They're going to do whatever they can to ensure that they make big money. And they do. We just had the earnings out. Some of the profit margins might be getting squeezed, but you're still making record revenues. You're still making record profits. So despite the fact that you got somebody in there, President Trump, who's saying we're going to drain the swamp, well, I thought the banks were at the heart of it. Well, they're making out like bandits as they are. So something's amiss. What else is amiss? Well, GDP, right? Because we had some other information come out today. We have U.S. construction spending unexpectedly falls. Now, of course, you're not surprised by this because we follow this information here on a daily basis. We're not surprised that it fell. Also, you have U.S. factory activity growth at 2.5-year lows. This is according to the ISM report. It's still above 50, which is that point of contraction or expansion, but it's declining, okay? This is the lowest level since October of 2016. So, what does this mean if we take this into the context of GDP? Remember, we had this conversation not too long ago. We had it on Monday, in fact, because the number came out last Friday, and we gave the report, the update on Monday, saying, you know what, first quarter, GDP 2019, something smells funny. Something's not right here. Because one of the driving factors of the GDP number hitting 3.2% was a build-up in inventories, although imports were down. Although a lot of the information that we've been hearing is that production is down. That's what we just said, U.S. factory activity growth at 2.5-year low. So how are you building inventory? How are you creating new inventory if imports are down and production is down? Where's it coming from? The tooth fairy bringing it? This doesn't make any sense. The other way that you would have maybe inventories building, I don't know, is if a whole bunch of people were returning everything. No, we don't want it. We can't afford it. We need the money. So take it back. I mean, that's not how it works. That's not how it's supposed to be counted. That just doesn't make any sense. So something is truly amiss. Also, what about the government shutdown? Wasn't that supposed to be a major concern of everybody at the beginning of the year, at the end of last year, and at the beginning of this year? Oh my goodness, we have this partial government shutdown. All these people, they can't go Christmas shopping. They don't have jobs. They're not going. What's going to happen? Q1 GDP is going to take a major hit. No, it didn't. It blasted through expectations of 2.5%, 2.3%. I mean, it just blew past it. 3.2% GDP. Makes absolutely no sense with all of the other numbers that have been coming out. So something is amiss. Something is amiss, and I just wanted to bring that to your attention again because I don't hear anybody really talking about the government shutdown. Remember, that was everybody's favorite excuse. Even from the White House. If there was a bad number that came out, oh, well, it's seasonality. It was the partial government shutdown. Those things will pick up through the second quarter, the third quarter. Those numbers will come back up. Well, evidently not. Or once we have the second quarter GDP number come out, well, it's going to be 3.5% or 4%. I mean, because if it was such a problem in the first quarter, and the first quarter GDP eclipsed all of the expectations, well, then my goodness, what's going to happen in the second quarter and going forward? I mean, if the number is higher than 3.2%, hang it up. Hang it up, because we are just being completely manipulated and completely lied to. Because you can't have a whole host of information that comes out on a daily basis that is with a negative bias to it. It's negative tint, I should say. And then say, well, we have 3.2% or higher in the second quarter of 2019. Obviously, we're a few months away from seeing that number, but nevertheless, just keep it in the back of your minds. What are they going to tell us? And then, if GDP does do as strongly as it did in the first quarter, well, why would the Federal Reserve ever go to lower interest rates? And then if the president was out again and his economics team was out again, following another, it's not a record, but another high GDP figure, what is he saying then? If they come out again and say, oh yeah, we got to continue to cut interest rates. I mean, what are they doing? He does need to be checked mentally. I mean, how can you say that we have to cut interest rates and embark on quantitative easing if we have a scenario in the second quarter of 2019 with GDP blasting through expectations to the upside? It's just not going to make any sense, folks. If that happens, there is no ifs, ands, or buts about it that we are being played, that there is some sort of master manipulation taking place in these markets. I already believe that to be true, but that's going to be it. That'll be the icing on the cake. They're going to write your name with a smiley face on it and say, look, you've been fooled, sucker, because that's what it is. And there's no other way to say it, because if you got a president of the United States coming out telling the Federal Reserve to embark and implement emergency measures, while at the same time saying this is the best economy in the world and it's the best economy ever, which we know not to be true, but nevertheless it doesn't stop the president from coming out and saying it. If he can say those two things, well, what other conclusion can you draw that we're being played, that there is some sort of game being played behind the scenes? Now, that's another interesting thing that I want to briefly discuss, because this is complete speculation on my part. But you have to ask yourself, why is the president and his economics team coming out and saying the things that they're saying in regards to lowering interest rates and embarking on another round of quantitative easing? Here again, it's speculation. But perhaps what the president is attempting to do is to just create as much currency as possible and spend that money like a drunken sailor. He's been, quote-unquote, rebuilding the military. We've had that conversation here many times. He's spent $2.1 trillion, maybe more than that over the past 3 years, on the military, on the Defense Department. So where's all that money going? Is it truly building up the military? I hope that it is, if in fact they needed it. Spending money, we just had the conversation yesterday regarding infrastructure. That's likely to be another $2.5 trillion worth of spending. Of course, that's going to take place over time, but nevertheless, that's going to be $2.5 trillion. We know by the $4.75 trillion 2020 budget that we are going to continue to experience trillion-dollar deficits as far as the eye can see. So my point here is the president attempting to run out and max out the credit card before he does something drastic involving the Federal Reserve? You have to remember, folks, President Trump is no stranger to bankruptcy. He's had several of his companies that he has started go through the bankruptcy process. He's stated many times as a civilian, and I even believe on the campaign trail, that he is a master of debt, is how he put it. He loves debt. Okay, well, at least he's being consistent with that. I mean, he wants the Federal Reserve to continue to print money, which is a debt instrument at the end of the day, because they don't issue it for free. They issue it at interest. So you got to pay back the piper plus interest. So he understands the bankruptcy procedures. He loves debt. Is he trying to max out the credit card at the Federal Reserve to just say, oops, we can't pay it back, so we're not going to pay it back, Federal Reserve, we're not going to pay it back, China, we're not going to pay it back, Japan, and a whole host of others, maybe even corporations, maybe even the banking system in its entirety? I mean, that's complete speculation. But when you have these types of statements coming out from the highest office in the land, the President of the United States and his economics team, saying we have to implement emergency measures at the same time when everything is fantastic, just doesn't make sense. So to try to make sense of it, you got to kind of maybe, peel another layer of the onion off and say, what's going on? What type of game might we be witnessing? What are we partaking of as sort of useless idiots, or useful idiots, if you will? We're just sort of the pawns in this game. We're just the sheep. We're just being moved around as they want. I mean, what is going on here? Does that make sense to you, that the president is saying, yeah, we're just going to max out the credit card, we're going to have the Federal Reserve lower interest rates, print as much money as possible, and then we're just going to default, basically. We're just going to go through bankruptcy because I understand it. I understand debt. I understand bankruptcy. I'm not afraid to go through that process. We're not going to pay the Federal Reserve back. We're not going to pay a whole bunch of banks back. Maybe we're not even going to pay foreign lenders back, or they're all going to take a haircut, and maybe they'll only get 50 cents on the dollar. What's he going to do? Because he also said in that tweet yesterday, if the Federal Reserve does this, it'll start to make our national debt look small. And we said, how the hell is he going to do that? $22 trillion and counting. How is that going to look small just because they start printing money and lowering interest rates? In fact, it's going to go up. So you got to read between the lines here, maybe. Again, speculation, but maybe let me know your thoughts on that, because it's interesting. And we're going to see some other things, because as this game of poker gets played, it's somebody's going to have to call or raise or show a card here sooner or later, and we're going to know what's really taking place. Because the other thing that has to deal with all of this, again, is, and I think this is an absolute, I think this is most definitely the president trying to dance himself out of the box that he has put himself into with taking ownership of the economy and the stock market and trying to lay this at the feet of the Fed. So if the market does in fact roll over, he's going to blame the Fed. He's going to say, look, my economics team and myself personally were out there telling the Fed to lower interest rates 50 basis points, 100 basis points, and embark on another round of quantitative easing, and everything would have been just A-OK. Now, again, we saw the markets sell off at the end of the day. One day does not make a trend. But if this continues, what do you think the president's going to do? How do you think he's going to play it? He's going to say, look, this is a correction. This is a big problem. The stock market doesn't like it. The economy doesn't like it. Why? Because the Federal Reserve refused to cut interest rates and embark on quantitative easing like we suggested. You should have listened to Trump. Trump knows what he's doing. So I'm telling you, people, he's going to take credit for all the good stuff. All the bad stuff, he's going to blame somebody else. In this case, it's going to be the Federal Reserve. And in all disclosure, in all honesty, I want the Federal Reserve to be abolished. And the Fed. Get rid of the income tax. Then you can start solving the problems. You don't do those two things, you don't know what you're talking about. Thank you so much for joining me today, ladies and gentlemen. It's been a pleasure having you. As always, please like, share, subscribe, get the word out, leave your comments. We would love to hear from you. This is the Capitol News. I am Alex Kreitis. Godspeed.